Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of the ultimate guide to municipal bonds investing. Investing in municipal bonds can be a smart move for those looking to increase their wealth while minimizing risk. Often referred to as munis, these bonds are issued by local governments, making them a key part of the financial world. But what makes them stand out? For one, the interest earned on municipal bonds is generally exempt from federal taxes. This can make them an attractive option, especially for those in higher tax brackets. In addition to tax benefits, municipal bonds are considered relatively safe investments. They're often used to fund public projects like schools, roads, and hospitals, making them essential to community development. Understanding the ins and outs of these bonds can help you make informed decisions that align with your financial goals. Whether you're a seasoned investor or just starting out, municipal bonds offer a stable and tax-efficient way to diversify your portfolio. What are municipal bonds? Municipal bonds, often called munis, are debt securities issued by states, cities, counties, and other governmental entities. By purchasing a municipal bond, investors essentially lend money to the issuing body in return for periodic interest payments and the return of the bond's face value at maturity. These bonds are popular because their interest income is usually exempt from federal income tax, and sometimes state and local taxes too. Types of municipal bonds. When considering municipal bonds, understanding the different types available is crucial. There are two main types of municipal bonds. General obligation bonds. General obligation, GO, bonds are backed by the full faith and credit of the issuing municipality. These bonds are not tied to any specific project or revenue stream. Instead, they are supported by the issuer's taxing power. This makes them a relatively safe investment because the issuer can use various tax revenues to meet its obligations. Security, backed by the issuer's ability to tax residents. Use of funds, typically used for public projects like schools and infrastructure. Revenue bonds. Revenue bonds, on the other hand, are supported by revenue from a specific project or source. This could be anything from toll roads to airports to water treatment facilities. The key distinction here is that the repayment depends on the income generated by the project financed by the bond. Security, backed by specific revenue sources. Use of funds, often used for projects like utilities, transportation systems, or stadiums. Both types of bonds have their pros and cons, but understanding these distinctions can help you make better investment decisions. How municipal bonds work. The process of how municipal bonds work is quite straightforward. Here's a step-by-step breakdown. Issuance. When a municipality needs funds for a public project, it issues a bond. This bond specifies the terms, including the amount of money needed, the interest rate, and the maturity date. Purchase. Investors buy these bonds, providing the needed capital to the municipality. In return, the municipality agrees to pay them interest, usually semi-annually. Interest payments. These payments serve as the bond's yield, which is attractive to investors seeking stable, tax-free income. Maturity. Upon reaching the bond's maturity date, the issuing body repays the bond's face value to the investor. Think of a municipal bond as a loan you give to a city or state. The city benefits by getting the money it needs up front, and you benefit by receiving regular interest payments that are generally exempt from federal taxes. By understanding how these bonds function and the types available, you can better navigate the world of municipal bonds and make informed investment decisions. Benefits of investing in municipal bonds. Investing in municipal bonds can offer several advantages that make them an appealing option for many investors. From tax benefits to low risk and steady income, munis have something for everyone. Here's a closer look at why you might consider adding municipal bonds to your investment portfolio. Tax advantages. One of the most significant benefits of investing in municipal bonds is their tax advantages. The interest earned on these bonds is usually exempt from federal income tax. In some cases, it's also exempt from state and local taxes if you live in the state where the bond was issued. Federal tax exemption. You won't have to pay federal income tax on the interest you earn from municipal bonds. State and local tax exemption. If you buy bonds issued by your state or local government, you might avoid state and local taxes too. High earners benefit more. If you're in a higher tax bracket, these tax exemptions can make a big difference in your overall tax burden. Imagine getting a paycheck that isn't taxed. Municipal bonds can make that a reality for the interest you earn. Low risk. Municipal bonds are generally seen as low-risk investments. They are used to fund essential public projects like schools, highways, and hospitals. Because they are backed by the full faith and credit of the issuing government, the risk of default is relatively low. Government backing. Many municipal bonds are backed by the taxing power of the issuing government. Stable investments. Unlike stocks, municipal bonds aren't as volatile, making them a more stable choice. Credit ratings. Most municipal bonds have high credit ratings, indicating low risk. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.